Hey there, Blockhead Traders. Here at Blockhead Traders, I must inform you that we are not financial professionals. Nothing we say should be considered financial advice. We offer our own thoughts and opinions to you, the viewer. We expect you to take these opinions, form your own financial conclusions, and make your own financial decisions. This is Blockhead Traders for the week of October 26, 2025. And in this week's episode, we are going to start talking a little bit about the middle class and the challenges that they might face, and kind of the concept of perhaps disappearing middle class, and kind of people in that range really thinking that the hills are getting a little bit steeper, and there's not as much prosperity that they believe that they should have at this particular juncture. So I don't suspect that this will be the first time that we touch on this concept. I'm not really sure how many times we'll kind of revisit it. We have quite a few thoughts to impart on the topic. But we'll go ahead in this episode and just kind of kick it off with touching on a few of those things. But before we hop to that, I want to give a shout out to our Discord, a link in the description below. You can hop in there, say hello to myself, Viper, some of the other Blockhead traders. Love to hear what you're trading, love to hear what type of content you want to hear about. Also, you'll find a link to thetagang.com/sprocket888 as well as /ViperXL007, where we post each and every one of our equity trades, the good, the bad, and the ugly. Also, this is available in an audio-only format wherever you get your podcasts. So look us up, subscribe, and if you can't find it there, let us know and we will get it there. But let's hop to this week's content. Viper, the middle class, and how they fit in and how they feel about where they are and where they're going, and the broader economy in general. Before we kind of hop into some of your thoughts on that, this is an interesting topic that you and I have kind of kicked around for a few weeks about wanting to kind of cover, and there's so much here to unpack. I do just kind of want to maybe start a little bit about history or background from my perspective on the way that I have seen things in the past, and really where it kind of starts to me is that returning from the war, the baby boomers, and the economy around that time, where it was all coming back to the war, find a good job, work really hard, put a bunch of savings in, buy a house, picket fence, white picket fence, apple pie. And it really was a very manufacturing-driven economy, lots of kind of production of goods, so sales within the country, really kind of that golden age, I think, of a lot of that economic things. And it was really kind of the birth of the middle class back then, where there was this newfound home ownership. There was wealth building in that. It was very attainable to a lot of people. And the reason I bring that up is because that was kind of the guys that my Viper and I's parents were kind of raised in, right? That was the environment that they grew up in. And so I think a portion of that methodology and that thinking and that environment kind of carried through with them. Companies kept you on board. You worked there for 40 years, 50 years. You retired from there. You had pensions. And that kind of established a lot of financial behaviors and a lot of things like that, which if you go back to some of the very, very first episodes of this particular podcast or this vlog, if you would, it really was kind of the genesis of where I started my trading journey. As I said, I had really been kind of raised under a lot of this: find a job, work hard at the job, dedicate to the company takes care of you. You save your money in your bank accounts. You get your interest. You buy your home, all of those things. And I kind of got frustrated where I didn't really see a lot of very viable path to kind of a comfortable retirement life. I watched my grandparents have a relatively comfortable retirement life. They had pension, they had ownership, they had wealth. I mean, not rich or anything like that, but very, very comfortable. And so that was really where I started kind of dabbling a little bit in the markets, and fast forward to today. And I really think there's been kind of a deterioration. I don't know that it's in a bad way, of some of that that, back in 1950s, 1960s, that the baby boomer, the rise of the middle class is really you'll hear it in the news. The middle class has been under attack. You have all kinds of inflation that is kind of raising up prices and driving what seems like a, decent salary on paper doesn't seem to buy as much as one would think. And so I think it's an interesting time that we're in, followed by all kinds of different news stories and stuff. I was actually reading in the Wall Street Journal a few weeks ago that one of the largest increases in market participation is kind of the lower income classes, and it was this whole article about how this younger generation is starting to pour a lot of money into markets and trading and retail. And I think it's actually relatively telling to kind of the journey that I myself found myself in. And while there's an increased number, I think there is a vast, large majority of the population out there that really is kind of scratching their head, going, "Why on paper does it look like I should be a lot more comfortable than I really am?" And why do they feel like they're not really in the middle class, even though by statistical measurements they really should be? And so, Viper, I'll kind of toss it over to you, because this is kind of the concept that we've kind of kicked around, and where to start and how to tear it apart and how to break down some of the topics. But how does this middle class, or this disappearing middle class, this rising challenge to it, how does it strike to you in kind of your realm of perspective?
Yeah. So there's a couple things I want to establish as far as what this is intended. So just like you said, I highly doubt this is the last time we're going to talk about this. And there's so much to talk about that I want to try to stay somewhat focused on a particular perspective of this. But throughout the whole thing, my intent personally is that this is a very interesting to me thought experiment of just analyzing the situation, sort of thing. Like, it's not to raise pitchforks of like, oh, we need da 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 da. Like, that's not the goal here. The goal is certainly just to think through thoughtfully the things that people are experiencing, and how does that affect those people? How does that affect me? And then, there's a whole cascading effect of personal responsibility from there that people may feel. So I guess where I'd want to start is since you kind of alluded to it as well, as far as the generational thing. One thing that's constantly gone through my head many times for years and years now, just as I look at the world landscape, whether it's economic, whether it's, whatever it is, personally, I'm fascinated by this linkage of how each generation has several, but it's a limited, so it's a handful. But I feel like each generation has a handful of ideas and behavior patterns that are imparted on them from the generation previous, so from their parents' generation. But in particular, it's not necessarily what the parents taught them. It's a negative thing that the parents experienced, which then the following generation is able to counteract and do better on, or something. So for example, the greatest generation, their parents were the ones that would have really been impacted by the Great Depression. And so I feel like that's where, like you said, the greatest generation introduces this idea of, all right, we're coming out of the Depression, we're coming out of the war, we're learning from our parents' pain, and we're gonna settle into long-term jobs, long-term, just you park it there, you work there, you get your pension, whatever, and ride that out. And then there's ways that then that generation could impart onto the baby boomers or the Gen Xers. Hey, I spent my whole career working at one place with this healthy retirement thing. You know what? You could work different jobs, or you could we start to get into the like mobility of like not of maybe chasing your dreams or whatever, which would be our parents, which were in still had roots in that one job pension whatever. But then it passes on to the millennials of like then there's this feeling of like, okay, well, you did just fine working one job, but maybe we could branch out and maybe we go further and like start job hopping around and then make more money by working here and then jump over here. And, there's sort of an evolution to that. So that's to say it's always on my mind of like, what is wrong with us? what are we going to pass on, through our experience to our children, to the next generation? And, that's just where my perspective is as far as the thought experiment. So the thing that brought this to light was overhearing a conversation between a couple friends who are, I would say, pretty well into the middle class, traditional middle class, and just hearing them discuss. I know that they're not, they do the right things as far as savings and keeping retail debt down and all that kind of stuff, paying down debt. But in their conversation, they don't, they're not exposed to any part of the market directly. Like there's no, what we talk about as far as having a drip in account and just having a small account and trying to pivot into it that way. They don't have the time or the resources to put into that. And so just hearing their conversation really brought this topic up to mind, because they were discussing how hard it feels and how frustrating it is that you do all the things, quote unquote, right. How in the world can a securely middle class, 2-income family still not feel like they're doing enough, still feel like the goalposts just keep moving in a way. And so obviously in light of this show, first place my mind goes is like, I mean, that is a core thesis of this show. Which isn't, hey, get in the market, let's all get rich together. No, it's the personal financial responsibility of get into the market to put more control over your financial future. And so then that led me down this road of like, is that a piece of what's fundamentally shifting in the middle class? Is the definition of middle class no longer have a good job, have a good retirement account, have good savings, and you're good to go? Is there now a piece of that that's integrating into, okay, if you want to be in this quote unquote middle class, that's not enough anymore. Now you need to have more control over your financial future by getting into the stock market or investments or trading or whatever. And so that's what kind of brought me to where we are now going into this topic.
Yeah, Viper, I'll say I've had similar exposure to conversations that are kind of what you're referring to there. And I'll say for me, one of the interesting ones that I come across, and I consider myself, relatively in the middle class of things, and a lot of my coworkers and stuff like that, I feel like we are kind of the definition of the middle class, middle working class, white collar employment and stuff like that. And one of the things that's really kind of stood out to me, at least recently, within the past 12 months or so, is a lot of people are real hesitant, like you said, about their financial prospects moving forward, the cost of what things hit their budget. Oh, it's so expensive to do this. Oh my gosh, is this? I mean, we try to go out to lunch, once a week or so as a team. It's kind of a pay your own way type of thing, but it's nothing to drop almost $20 on a lunch. Even going to fast food or something like that, you're probably dropping $12 to $15, which is 3-4x what's we're kind of used to. And so there's what I mean by that is there's a lot of kind of economic or poor outlook that a lot of my coworkers, my friends kind of have around that. But at the same time, a few of them kind of talk about, hey, the market's now at an all-time high. I don't know if we hit another all-time high today. I suspect we pulled back a little bit, but there's lots of it just seems like an interesting contrast that's kind of going on where the sentiment, and I know this is a big thing for me, that a lot of people equate stock market to the broader economic conditions, which is not true. The stock market doesn't always equal. There is a relation there, but I really feel like there is this interesting contrast between what you see when you flick on CNBC or analyst coverage or read the Wall Street Journal as far as the market's performance. And then I just, we go out to lunch and stuff like that. And the perception that a lot of my coworkers and stuff have on their personal prospects and kind of future financial independence and stuff like that. And so I don't know, Viper, are you kind of experiencing a similar thing in your circles of discussions?
Yeah, absolutely. And that what really started bringing this topic to light as far as something that I wanted to regularly chew on and then ultimately bring up here. And like I said, this is just scratching the surface from two non-professional, just learning by the seat of our pants. But one of the things that started the confluence around this idea, like you just said, is both myself in my own life, but also in that conversation and in other circles. What felt so weird is that what you just said, the stock market hitting all-time highs and stuff like that. And I remember the last cycle, because that was when we got into trading, started the show and everything. The feeling was just so different when the stock market was hitting all-time highs back then, where now I feel like we're hitting all-time highs and it's almost like the fireworks are going off and you look around and everybody's just moping around, and there's just this massive disconnect. And so, of course, everybody has hot takes and curious observations of it's got to be this, and finger pointing and whatnot. But that's obviously to longtime viewers not what we're about here. But there's still something beneath it, and so getting to the core of our entire thesis of knowing what you're trading, I feel like it also applies know where you're trading if it's interesting to you to know that underlying mechanics. So. What I thought was really interesting, I want to jump over to a particular chart that I came across in my curious endeavors, as I do. And so this is certainly not a chart, like I said, not a chart that I've created. It comes from a YouTube channel, Bravos Research. I don't regularly watch it, but I mean, it came up on my algorithm. It sounded interesting. I watched it. Turns out it was super interesting. So maybe we'll link the video just for full effect here. But this so I already had these ideas percolating of this weird disconnect that I was seeing, and then I come across this video, and this chart jumped and just screamed at me. So this is a chart of the consumer sentiment charted as well as the consumer confidence in stocks. So the white line is the consumer sentiment. The consumer sentiment is a result of a survey out of the University of Michigan, where it reflects how consumers feel about the current economic conditions and their willingness to spend or save. So this is just kind of people's personal sentiment towards the economy based on filtered through the lens of their own finances. Like, am I willing to get out there and start buying things and all that sort of stuff? The consumer confidence in stocks is, as the name implies, it is the consumer confidence in the stock market. And as you might expect with that very brief explanation, it makes sense to see these travel somewhat together. As the stock market goes down, people in the market, or the stock market being sort of that leading indicator of where the economy is going. As the stock market goes down, people's confidence goes down because you just see red news all the time. Stocks are plummeting, And so people's confidence, the sentiment goes with it. And so this chart goes all the way back to 1996. So we're looking at, roughly 30 years, just under 30 years of data here, and it travels together pretty consistently. Certainly trends in the same direction. until recently. So we're looking 2022 to current. The confidence in the stock market is just ripping, versus the consumer sentiment is clearly downtrending and near, rock bottom for this 30-year period. And that feels significant. And it feels representative and relative or relevant to what we're experiencing anecdotally. So I found that super interesting to then start to unpack that thought process of what does that mean? And I don't claim to have that answer. It's something I'm still considering and thinking through, other than at the very high level, something is disconnected, and these two lines, given what they represent, doesn't seem sustainable to be diverged from each other. And so I think through, what does this mean as far as what could be driving that consumer confidence in stocks? There is a whole bunch of rabbit holes that I'm going to very intentionally sidestep here as far as what's driving the stock market. That's a whole other AI bubble that is unfolding this year, which has a whole other implication as far as everything around that. Super interesting there as well. But it is market participation when consumers are not willing to spend money on goods. And that is a very interesting thing. And then my mind goes to my own participation in the market. How does that impact my personal strategy? Because we're following that logic trail, and that logic trail says, if that's true, then there is a bubble in the market that is probably unsustainable, of massive market participation when people are not willing to spend money on goods, or save. That can't be sustained, because that is just pumping and propping up the market. So, not trying to sound doom and gloom and doomsdayer, but that's got to end at some point, right? And I know this point really probably resonates with you, Sprocket, as far as how I know you've been positioned for a little while now, in some of these positions that we've done episodes on how that's working out for you. And so where I go with that is, it doesn't stop how I am currently active in the market, but it is important context, I think, to me, because it is affecting the amount of risk on the amount of parallel trades, that I take in my account, because no one can predict when a bubble is going to pop, and no one should fear being involved because it's going to pop at some point, because it could take 5 years, it could take 10 years, it could take tomorrow. And so that's where we get into what we always talk about with position sizing and mitigation and all that sort of stuff. So me personally, and how I'm dealing with this is, my strategy that I've been talking about a lot here, the momentum skew strategy that I deploy, is actually starting to pick up on this a little bit, I think, because the market has been pulling back. And what I thought was really interesting in how the market's been pulling back, the momentum skew strategy works in both directions. And I've been taking a lot of losses recently, and that has been that upwards momentum that's been teetering out. And those last rounds of trades that I put on are not hitting profit. They are expiring worthless, as it feels like. And I'm not saying the market is reverting, but still, as we're plateauing, these trades are just starting to fail. But the screener is also picking up less and less and less opportunities in the upwards direction. They are starting to pick up a couple momentum trades going in the bearish direction, going down. And so that has me feeling confident, I guess I would say, that that's the kind of strategy you want to look for, is when I'm not afraid of the thing popping. My source material, my screener is reacting accordingly. I'm getting less and less trades in a bullish direction. It's not forcing trades. It's showing some pretty meh trades. So I'm just sitting out and waiting. And if we do start going down, then it starts picking up bearish and downtrend trades. So that feels somewhat comfortable or confident. And I think ultimately that's the kind of strategy you want to look for, is the kind where, yes, I'm taking losses right now, but literally, I mentioned the Sprocket. I might have mentioned it on the show, but certainly in messages, this strategy that I'm running is not supposed to be 70% win rate, but it has been. And so I was like, the law of averages are going to kick in here. And here they are. And that's the time when you want to have that confidence to know that the law of averages is still in your edge's favor, which means it sucks to just see loser, loser, loser. But you got to look at the big picture of the strategy and say, this is a course correction on my statistics. And the strategy is, the edge is that I continue to take trades that match the thesis. So as we shift, as bearish trades show up, I start taking those, and everything balances out in theory, but also in statistical probability. So in a long roundabout way, that's kind of where my head's at. It does mean the newcomers. I feel bad being like, you got to get in the market when it's potentially a top. Who knows? Top could be anywhere. But I think it at least strengthens the argument of, position sizing and portfolio sizing is more important right now than I would say ever, because of where the market is at. But that doesn't mean you need to be afraid and stay away. So I don't know. I mean, I know you're Mr. Short on a couple painful positions. Are you feeling any rounding out like that, or are some of those short positions just kind of still paining along or rolling along? How's it feel from your strategy's perspective?
Yeah, I mean, my overall strategy, I'm still really comfortable with it, just like you're comfortable with yours. And I think it's because my overall strategy is very much hindered or centered around tiny minor trades, the very small position sizing, 1% to 2% of my portfolio. And they're short term, so they're in, they're out, which gives you time to adjust and pivot to whatever the broader market is doing. And so, yes, I do actually overall generally have a relatively short delta position, which means on the market, I'm short on markets. I do have specific short positions open on indexes like the Russell is a big one that's kind of been out there. And I'll say it's not been bringing me much pain because we really haven't been pushing higher and higher. We kind of push higher, then we fall. Then we push it a little, try to push higher, and we fail and we fall. So it's not really printing per se. It's not really in profit, but it's not bleeding very fast anymore. And the comment that I actually want to bring, because the chart that you had kind of shown up, and I'm going to bring it up here to talk a little bit more about it, really I think stands out as to why, or at least I'll share with you why I kind of feel the way that I do. And it really kind of echoes the blue line there is your consumer confidence in the market. And honestly, I don't know that really should matter that much, because what's driving the market isn't really what the consumer thinks about the market, right? You can think anything you want about it, but if you're not an active participant in it, you're not really influencing where the market is going. That's just your opinion on it. Now that opinion is reflected in a lot of people that are in the market. And that part reminds me of Warren Buffett's famous quote, be fearful when others are greedy, and be greedy when others are fearful. And to me, when you are pegged at this absolute all-time euphoria confidence in the market, that means that others are greedy, right? That's a signal that there's greed out there. And that's where Warren Buffett says, be fearful, be worrisome of what might come here, because people aren't really thinking straight. They're just, we're going forever and ever and ever. Now, the interesting contrast to that is that white line that you have there, where that's the consumer's opinion on their economic prospects and their future financial perspective. And I think that this is very, very important because I have I always talk to people, and I ask them, well, what do you think? What do you think? And my job and not market related. They're like, well, why do you always care so much what people think? I said, because people's perception is their reality. Right? The way that you perceive something, whether or not it's true or not true to other people, it is the reality of that person whose perception it is. And in a capitalistic economy, consumption drives the market. It drives profitability. It drives margin. It drives earnings. It drives all of those things. When consumers stop spending, all of that comes to a crashing, screeching halt. And that's why I pay attention to that white number a little bit, because when people feel bad about their prospects, when they feel bad about their situation, they're going to start scaling back their spending. They're going to, go out to dinner less. They're going to take less trips. They're going to, they're going to kind of clam up and be more self-preservation, because a lot of the people have been out there and alive through the economic collapse in 2008 and stuff like that. And people are going to scale their spending back. And that is a dangerous combo when the market and all these companies become over leveraged and really kind of levered up, because as soon as that spending stops, it's like the rug gets pulled out from under a lot of these things. And that's where you really find these companies that have stable cash flow, good cash balances, good reserves, right? They're the ones that will weather the storm well. All of the other companies that are kind of borrowing out the wazoo from venture funds and taking all this money because money is flowing freely because everybody's dumping investments in there, those are the things you kind of have to look out for, because when that rug gets pulled, there's not a strong foundation for those companies to fall back on to survive the storm. And that collapse in the stock price can be quite precipitous in that condition. And that's why I think this is an interesting chart, because it kind of brings a couple of those things together, at least that I kind of look at in there, as far as what do people's perceive there, and what are others acting as far as the market goes. Be fearful when others are greedy, and be greedy when others are fearful.
Yeah. And that made me think of one thing, just looking at this chart here, there's a fundamental thing here, where if we look at the white line, today's white line is approximately at the same level as 2008, 2009, levels. And that is shocking to me in some ways, because like you said, consumer spending drives that market or drives the profits and the margins in the market and things like that. So to me, and this is where I promised not to get too into it, so I'm leaving this as a little teaser and encouraging further digging from anybody that finds this topic interesting. If consumers are as unwilling to spend as they were in 2008, market does not reflect that at all. The market is up, as if margins were printing on a ton of consumer spending. And so what that seems to indicate, and there's other pieces of data, this is the nugget of the trail to follow, is what is spending. Somebody is spending, because the margins are there and the profits are there, and thus the market is going up. And so that's where that little AI tidbit dropped in of a bubble that seems to be just ever increasing and ever growing, is the spending around AI infrastructure, and just all of this other stuff. And so that is an entire other topic, but I think it ties into this as far as some of that disconnect of, if consumers are not spending, where is the money coming from? And there is this massive elephant-sized AI bubble and the spending that's going on in that sector, which then, to Sprocket's point, is certainly now the risk gets even higher of things popping, those margins disappearing, and then just everything coming to a grinding halt. So plenty to discuss in that direction, but definitely not trying to derail at this point.
Yeah, no, it's It's interesting, and I think we shan't dive too much more into some of this just for sake of time in this week's episode, but definitely more to unpack there. But as far as squeezing of the middle class and stuff like that, I think that there really is a shift there in that the middle class is now expected to hold that ground. You have to augment your day job, whether or not some people are trying to augment that with other day jobs and have multiple day jobs. Some people are augmenting that with another income stream of market participation and trading. And that's just an interesting thing to kind of watch and observe. Myself and Viper being first-class citizens in that world of trying to augment our primary income stream with something else. So that brings us to the end of this week's episode. Like I said, this is just kind of a first scratching of this series of just kind of what's up with the middle class? Where is some of that stuff, and how do you build some of that wealth, and what do you do? And is it all just throw your hands up and give up? And I think it's not, right. It's the power is within your drive and motivation to do something about it. And I think kind of getting into the markets, getting into trading is a way that you can augment your income stream without dramatically. It's not linearly proportional to your time, right? It's once you kind of dial in on a strategy, dial in on that, you can get more and more output with the same amount of time, or you can still get the same amount of output with less and less time. And I think that's something that really can scale, but it takes a little bit of time. It takes a little bit of energy. It takes a little bit of motivation to kind of look into that. And when you go into that, you really just can't think, yeah, I'm just going to pour money in here and it's going to print. You have to be a little bit cognizant about the strategy that you're deploying. You have to understand why you're doing something. What is it doing? Viper and I both are trying to hone in on strategies that are relatively agnostic to direction, right? You find a strategy that works when the market's going up, works when the market's going down, works when the market's going sideways, and that's really kind of what's important there, because that has resiliency, that has scalability, that has longevity. And so that's really why we started this show, or at least why I started this show, was to really kind of just share the journey of myself. And then I snagged Viper and made him appear on a few episodes because it was really weird to talk to a camera by myself. But that's really where a lot of this came from. So, we'll touch on this more in the future. If you find this interesting, let us know. If you find this boring as heck, let us know. Otherwise, we'll just keep doing whatever we want to do. So we'll look forward to your feedback to kind of help guide us. Otherwise, good luck out there. Have fun. And remember, think outside the block.